It's a great pleasure to have with us Ken Shubin Stein. Ken is the founder of Spencer Capital Management and professor at Columbia Business School, which has a long tradition in value investing. But before we get to the investing part, I'd love to hear about your background and what got you started in investing.
Well, thanks. I had a very circuitous path to becoming a professional investor. I grew up in a family of all doctors and scientists, and when I was young, my mom, who was also a very good investor, was in charge of our family finances and investing. And when I was maybe 10 or 11 years old, she taught me about the stock market and helped me pick my first stock, which actually was a biotech company that developed the technology for polymerase chain reactions, which was a crucial technology to help DNA analysis progress. And it was one of the very few biotech stocks I've ever invested in my life. And from there, I was fortunate enough to stumble across Berkshire Hathaway in the early 80s. And that really is what kind of opened the door for me. And it immediately made sense to me. Buffett writes in such an accessible way that even as a kid, I was able to understand some of it and relate to it. And he makes it, of course, part of his genius is he makes it seem so easy that we all feel like it's understandable and we can do that. And that's kind of what got me very excited about this. And from there, I've just been a lifelong student of value investing and practitioner. And sometime in high school, my parents let me sort of take over managing our family investments and retirement accounts. I went through college and medical school and part of residency, continuing to manage money for a few family and friends, and then made the decision at one point that although I love both medicine and investing, to go down the road of being a full-time investor while still doing public health volunteer work through Crutches for Kids, the charity that my sister, brother-in-law, and I run.
And when did you start Spencer Capital?
Spencer Capital started in 2000. And under a predecessor name of Kenshu LLC, and then for legal reasons we converted it it's a long story, but basically we started in 2000 and have been going ever since.
Tell us a bit about the investment approach at Spencer Capital. What kind of investor are you?
Sure. So we're value investors, of course, and we're concentrated value investors. We look for investments in three types of situations. One, generally undervalued securities. So things that Buffett used to call the generals, or generally undervalued securities. And sometimes those are available in great quantity, such as during the latter part of 2008 and early 2009. And sometimes they're not. It really depends on market conditions and the market cap size you're looking for. The second type of investment we look for are special situations. These are almost always available. And they're a result of either corporate actions like debt recapitalizations or spin-offs or bankruptcies, or temporary problems the company may be having, like a product problem, production problem, or supply chain problem. And basically, they're situations where something's going on, it's clear it will resolve, and through analysis, one can figure out the long-term value of the company after whatever's occurring transpires versus the price of the security, whether it be a stock or a bond. And the third situation we look for are activist situations. These are situations where we look at a company, we think there's a lot of value there, but in order for that value to get realized, the company needs to either change strategy, change the board, or change management. And we seek to influence those decisions either privately behind closed doors or publicly via a proxy process.
And how do you generate investment ideas? Perhaps there are different ways in the three different segments that you look at.
Sure. So the world is awash in ideas because of services like yours, as well as a bunch of others. There are sources of very good ideas from cultivated sources, as well as general ideas that come to us from people we know in the business. Having now done this professionally for more than a decade, we just get ideas in every possible way. We have former students call us with ideas. People I've worked with over the years call us. People send us ideas to see to check their analysis sometimes. We get ideas from sources like Manual of Ideas. And we also run screens, and we read the newspaper and read generally looking for things that fit our criteria.
And how do you go from generating the ideas to making an investment? Can you walk us through the process behind that?
Sure. So we spend a lot of time trying to be good at research process. We generally take the perspective that if we focus on being excellent at process, we'll have enough good outcomes that the overall results will be satisfactory. So we feel that process is the one part of this we can really control, and therefore invest heavily in it. And what we seek to have is a process that is structured enough, that it is explicit, teachable, measurable, and improvable over time. And that last part's very important because we're always trying to look at what we do and figure out how to do it better. But at the same time, with that structure in place, is still flexible enough to handle different types of investment ideas. So for example, the exact way we would research an operating company that sells a service, let's say a service or a product, to retail customers that does not have a, let's say it has a strong balance sheet from a liquidity position, but doesn't own massive assets, but it's just is a standard sort of business in America. The way we might analyze that is very different. That let's say it's a high free cash flow, high return on capital business that turns over its working capital very rapidly. That would be a different specific analysis than something that is a large asset that is currently not producing any cash flows, but may have tremendous long-term value once a few things occur. A great example of that is, for example, undeveloped land, or land that needs to be repurposed in the future. They both may be very valuable assets, and the price of the securities of those companies may be very low in relationship to them, but we need to tackle the research process differently. So that's really what we do, is we look to have, we look to have this, what we call the four-step method of analysis, be structured enough to be improvable and flexible enough to address different types of ideas, including bankruptcy, special situation, activist, etc. The four steps that we use are, first we come up with a hypothesis. Why might this be interesting? What do we think is going on? That's step one. Step two is we then say, okay, what are the important questions that need to be asked to understand this better? And how do we get the answers to those questions? So step two is analogous to designing the study in the scientific method. Step three in the scientific method would be the experiment itself. And for us, it's actually doing the work. It's going out and getting the information. It's both qualitative and quantitative information, whether it's analyzing the financial statements, interviewing people in the industry, reading broadly, just how do we get the questions answered? That's step number three. Getting the questions answered is step number three. And then step number four is analyzing the data and then testing our hypothesis. And basically those four steps, iterated again and again, help move us forward in understanding something. And at each iteration, we stop and we pause and we say, okay, what do we think is going on here? What are the critical questions we need to ask and answer? And what is the most intelligent way to proceed? In addition, I should say that we try to kill our ideas very quickly. So we take the position that time management is one of the most important things to be successful in this business, and therefore we're trying to kill ideas. Now, we don't mind if we have a high false negative rate, meaning we may kill a lot of ideas that are perfectly good ideas, and they might be great ideas that we're just going to miss, and we're okay with that. What we really want to avoid are false positives, things that we spend a lot of time on and maybe even invest in that we should not. So because of our inclination to really avoid false positives, we are constantly trying to kill ideas early on. And we may kill an idea because we discreetly understand why we would not invest in it at any price. We may kill an idea because we decide the price is just too far away from what we think at this early stage of analysis the value is, in which case we would put it on our list 4 with a price to come back to. Or we may kill an idea for nothing at all and for no reason at all. And what I would say, something I'm much more comfortable doing now than I was earlier in my career, is I really have a much greater respect for sort of the gut feel and general feeling of why I might not want to do something. And even if I can't articulate perfectly why I don't like an idea, I've learned that it's much better for me if I don't like an idea or I don't feel comfortable with it, even if I can't articulate why, to kill it and move on.
And could you give us an example of an investment, perhaps a past investment you've made that really exemplifies this process and is a good example of the discipline that you bring to this approach?
Sure. So one of our investments, in the past we've invested a lot in real estate at various stages of various types. Howard Hughes is a good example of one of our investments where, we had a hypothesis, which was that this was a spin-off and a bankruptcy situation. So we thought that was a good place to start. The management and the board are superb. Bill Ackman's chairman of the board, and he hired a superstar group of managers to run it who put their money into the company as well, so it aligned incentives. We felt we understood the assets because they're real estate and we have a lot of experience in valuing real estate. And we also understood why do we have an edge. And that's a very important question. That is part of our four-step process that we have. We have a checklist that is, and we have actually quite a big checklist. We use parts of it for different types of ideas. And one of the important questions we always ask ourselves is, what is our edge? Why do we think this security is mispriced? And why might we understand this when other people don't? So with Howard Hughes, we did sort of a qualitative top-down analysis of the situation, but then we also did a very specific bottoms-up analysis. We looked at every piece of property they own, and we looked at what we thought the current comparable value comps are of that property in their current local markets. But also, we added to that, what do we think it's worth over time, given a few different possible future pathways. And then lastly, I'll say the thing that made me most comfortable, in addition to all this very granular specific work, and this sort of top-down, this is why it might be cheap kind of stuff with great people running it, we then read very carefully the bankruptcy documents. And the great thing about a bankruptcy is that there is a massive amount of information that's disclosed to the public when a company is bankrupt. So General Growth, their parent, was bankrupt in bankruptcy process and had to discuss the Howard Hughes assets that they were then spun out. Howard Hughes was spun out of General Growth. So we were able to go through and say, okay, here's what the carrying values are of those assets. And then we were able to see very specifically, and this was a fantastic find for us, we were able to go through the bankruptcy documents and see exactly how did they determine the carrying value, the balance sheet values of those assets. And it was just fascinating reading because we were able to see piece by piece how they made 20-year or 25-year projections of cash flows discounted back by very high discount rates and what other factors they were putting into it in terms of the timing and the magnitude of those cash flows. And we were able to see that they put in extremely conservative assumptions. Now, that was appropriate. The world was awash in uncertainty. Long-term illiquid assets deserved very high premiums to invest because investors had a lot of other alternatives that were high cash flow generative ideas right now, let alone waiting. So everything they did we thought was 100% appropriate, but it was also clear that if you had a longer timeline and were willing to dig through those documents, you could see that there was a lot of opportunity for things to go well. So we felt that it was a very asymmetric situation. If things went poorly, we thought we might lose a little money in the short term, but over time we felt we would at least break even. And we felt that if things got slightly to moderately better in the world, we could do really well. And in addition, we were very comfortable with the fact that Bill Ackman is running the show, and Bill is, a very ethical, very talented shareholder value creator, and that was great for us. So we love situations like that, where both kind of everything came together. We had fantastic people, the company had fantastic prospects, and we thought the price was fantastic. So that's an example of how we do our research, both qualitatively and quantitatively.
Do you remain invested? Can you talk us a little bit through your selling discipline and where do you think intrinsic value is with this company?
Selling is difficult. So I will say that I think an area where we could certainly improve how we do things, and I'm always thinking about this, is on the sell side, the selling aspect of an investment. So if we're going long something, it's easier if we think it is a mediocre company that's very mispriced. If we think something's mediocre or average, and most companies are average, and we take the position that almost all companies become average over time, So if that's where we're starting, it's a lot easier to sell, because basically what we try to do is we try to buy it in as much of a bargain price as we can. And then we sell it at a price where we think the buyer from us is getting a good deal. We don't try to take the last dollar off the table, particularly with average businesses or businesses we expect to become average over time. We just try to make sure we've bought it cheap enough and we sell it at a price where the person buying it gets a good return. And that's part of our margin of safety. It is much more difficult for an idea like Howard Hughes, because Howard Hughes is going to play out over 5, 10, 15 years. A lot of factors go into what it's ultimately worth, which include inflation and cost of financing and the timing of the developments. So that is much more in the category of, we still like all three things. We like the people involved, we like the prospects of the company, and we like the price. But it's very hard to know what the future price to sell it at is. We just keep redressing the issue and checking in as we monitor the investment. Do we still think this is true?
And you talked about one category of your investment opportunities being situations where through activism you could create value and get to the value that you think exists in a situation. Can you walk us through an example of such a situation and what specifically you pay attention to?
Sure. So activism, which is where an investor seeks to influence the decision-making of, or change the board and management team or management team, is something we've had a lot of success with over the last decade. We've done everything from ride other investors' coattails, which is my favorite form of activism because we get a lot of the benefit without doing the hard work. And someone we know is the activist and we understand what they're thinking and they articulate their thesis well enough for us to be able to understand and act upon it. That's great. And that's one type of passive activism, or sort of activism, getting involved in activist situations where you're not doing all the work. Another type of situation we've done a lot of is quietly communicating with management and trying to make our case. We take the position that good ideas will generate their own following, and we try to logically present our opinions and our ideas. Oftentimes, management is incented not to listen or not to understand. And it's very hard to get someone to understand something if their paycheck depends on them not understanding it. I forgot where that quote originally comes from, but I thought, but it was something I heard a lot when I was in this business and made sense to me, and I've lived it. And then the most sort of public way to be activist is the way we were with, let's say, Osteotech or MRV. Osteotech's probably a good example. That was a situation where we understood the products and the industry extremely well. They worked in orthopedic surgery, an area where we have deep expertise. It was clear to us what we thought management and the board were doing wrong. It was clear to us why we thought incentives were misaligned. And it was also clear to us what the strategy of the company should be, in our opinion. We had a strong opinion as to what the company should pursue as a strategy. And we made our case to the public. We made our case to the large shareholders. And we ran a proxy fight. And the week the votes were coming in for the proxy fight, the management sold itself. Management made the decision, and the board made the decision to sell themselves to what we thought was the most logical buyer from the beginning, which was Medtronic. And this was a case where we believed that had we not gotten involved, that outcome would have never happened, because the board had many times in the past turned down offers and refused to seek to go through a process and see who might be a better owner of their asset.
And it's interesting, the example you mentioned with your background in medicine. Can you walk us through how that may have helped you and given you an edge there?
Sure, and in Osteotech, I'll take a step back. Often, I think the benefit of my scientific and medical training is in just helping us understand how to do research better. And that skill is very broadly applicable. In Osteotech, it was broadly applicable and helpful, but also very specifically, my understanding of orthopedics, not just the science of orthopedics and the surgery of orthopedics, but also how the industry works, how the players in the orthopedic industry relate to one another. That was very helpful in us understanding and articulating our strategy. So when we made our point, our case, we were able to do so in a very compelling way, and we tried our best to express to people why we thought we understood this competitive dynamics better than the management team and the board did. I think with reflection, I would say it's clear, and they eventually followed the path we laid out, so it's clear that I think the strategy and the competitive dynamic analysis was correct. They may have understood that earlier on, but also they were just incented not to. And back to the prior statement, it's just hard to get people to do things when they're incented to do something different, even if it's logical.
Now, activism is a very tough area, and many
Yes.
great investors fail there. Can you talk more broadly about some of the benefits to activism and also some of the dangers and how it may impact the larger society, not just the immediate
Sure.
players?
Well, I have strong opinions about the fact that I think activism and short selling are very pro-American. They are, and I think they're pro-global capitalism. Almost every dollar in capitalism is tilted in the direction of being a long investor. And it's tilted in the direction of buy stocks or bonds, don't impact management, and promote these things to go up. A fraction of 1% of global capital, in my opinion, is the other way. Either activism, which is trying to change the course of management, or shorting, and shorting the stock and making an economic bet that it's going to go down. And it's really important that those things exist in our markets. They keep people honest. So management and boards have a lot of incentives that are not aligned with common shareholders and debt holders. And it's very important to have some check in place to keep them from the boards and management teams of companies to ignoring the common shareholder. Now this is, in general, largely I think because of activism and short selling, the world has gotten better on this particular topic. I think slowly corporate America is becoming more sensitive to shareholders. Back in the 80s when I started, management teams were incented on revenue. Not revenue per share, just revenue of the enterprise. And that's a horrible way to pay people, because you can sell an unlimited number of shares and you can take on as much debt as the world will give you to buy businesses or invest in areas to create revenue. That doesn't mean that we're improving free cash flow or intrinsic value per share. And that's what you care about as an equity owner. Now, comp systems more regularly include things like return on capital, free cash flow, per share economics. So I think the world is coming this way slowly, largely due, like I said, to investors who are willing to speak up and either say they disagreed by shorting the stock or by trying to seek change. Also, I would say short selling, and I think both Bill Ackman and David Einhorn are great examples of this, are really important mechanisms by which frauds and bubbles and incorrect business models can be exposed. And there's a great example is, I would say, Bill Ackman with MBIA or David Einhorn with Lehman Brothers, where they clearly exposed something that was wrong. Allied Capital, the subject of David's book, is a great story that I think every investor should read. And I really feel that all of us who participate in the capital markets, even someone who's never going to short a stock in their life, it's worth reading that book and reading about how both of those investors have sort of battled with the companies they were short, because it highlights, one, how hard this is. It is so difficult. Both Bill and David battled with MBIA and Allied Capital, respectively, for years at great personal and financial expense. They battled these companies. They let the world know something wrong was occurring here. All the while, the management teams of those companies were trying to discredit them and harm their reputations. So at the end of the day, of course, they were right and the companies were wrong, and it's better for the capital markets that frauds and bubbles are exposed. And this is why I think even if one never wants to short a stock or be an activist, it's important that the system allows it, because we all benefit from the work that these people do.
You talked about a couple of examples that have worked out. I'm curious to understand perhaps a few situations where things didn't go quite as you had expected. And if you could
Right.
tell us a bit about some of the lessons there.
So, sadly, we have mistakes to choose from. We have no shortage of mistakes over the last 12 years that we've been in business. And what we try to do with mistakes, we actually take mistakes very seriously. A mistake is just a bad outcome unless we get to learn from it. And if we can learn lessons that we can profitably apply in the future, it hurts a little less. So what we do with our mistakes is first we try to identify them. And that's the trick. Sometimes if an idea blows up, and I'll get to some specifics in a moment, but first I want to frame how we think about mistakes. We try to understand them, expose them, realize they occurred, and then think about what could we change, either by adding something to our checklist or changing a practice in how we do our jobs to prevent the same mistake from happening again. Ideally, we'd like to learn from other people's mistakes, but oftentimes we have to learn from our own as well. A good example of a mistake, I would say, would be Celebrate Express. And Celebrate Express was a small company that we thought had a great core business. They were an online retailer of birthday party supplies for upper middle class and affluent families. And we thought this was great. There was a clear logic to why they existed. Parties, you have to buy a lot of things for a kid's party, and they're themed, and the typical consumer, when they threw one of these themed kids' parties, had to go to 2 or 3 stores to find them all in person. It was very inefficient and inconvenient for typically the mother who would drive around. This company had a client log of over 2.5 million upper middle class and affluent mothers in America that had bought from them before. And the great thing is, when you sell party supplies, you know in a year you can sell to that same person again. So you know when your next sale opportunity is going to come up. The company had done pretty well. We thought they had a good core business, and they had a manufacturing and a supply chain sort of problem. They had some operational issues that we thought were fixable. And they had a strong balance sheet. The problem was the founder of the company and some other people were involved, we felt, weren't going to get to the right place. So we teamed up with Stefan Roseman from Thesis, and we partnered with Stefan, and we ran a proxy fight, and we got involved with the company. And we ended up not going through the full proxy process, as often happens, and we got on the board. And we were a minority position on the board. Once we were on the board, we worked with the company to analyze its cash position. And the company immediately, we were able to help influence the company to immediately improve corporate governance on 5 or 6 things. So that was good. The mistake was a couple-fold. One, we thought we had more excess cash than we really did. And 2, and that was a minor mistake because the company still had a strong balance sheet even after we gave a special dividend to shareholders. But going into the worst recession since the 1930s, of course, we would have preferred to keep the cash. But in almost any other environment, that part would have been okay, which is why I think that was a small mistake. The bigger mistake was being a struggling turnaround online retailer going into a very severe recession. If you're small and subscale, is a hard place to be, particularly because the company was headquartered in Seattle. And being headquartered in Seattle is an illogical fact for an online retailer like this. It's a high-cost place. Most good retailers and people you need to work at an online retailer don't live in Seattle. And one of the unintended consequences or unintended results rather, of the credit bubble bursting in real estate is that it made it very difficult to recruit executives that we could afford at our small size as a company and get them to move to Seattle. And it was also very difficult to move from Seattle to a lower cost place because of leases and other things that were in place already. So part of our mistake was not understanding exactly what we could change and what we couldn't change. And part of our mistake was not understanding how bad the recession might get and its impact on the company. So what ended up happening was the stock price fell. We still had a good balance sheet. Customer orders obviously dropped off because those are discretionary items, and in a recession, those get cut. And being a public company, the shareholders didn't really have the patience to get through the recession. And we ended up having to sell it at a price well below what we paid for it, even net of the dividend that we got back. And it's a terrific long-term business, we believe. So it's the kind of business we would have been very happy to own privately, but part of the mistake was thinking about having a small turnaround in a public company format and not fully understanding the fragility of that situation when there's a significant recession. So now that's something we think about. We think about how fragile might not just the company be, but its shareholder base be in the face of a significant recession.
And speaking more broadly, based on your observations and understanding and vast experience, what is the single biggest mistake that you think investors make?
I can talk about the single biggest mistakes I've made. I think I'll name a few. I don't know if there's one big one, but I would say seeking confirming evidence for something one already believes is a huge mistake. And it's very common in certain fields. So I think what happens a lot is somebody has a thesis and they look for evidence that their thesis is correct. And the problem with that is it ignores all the other evidence that one might not be correct, but also it ignores the fact that the evidence being collected may support one's thesis, but that same evidence may support alternative hypotheses or theses as well. And unless you consider that, it's hard to really understand what the evidence means. What information can you gather from the data you're collecting? And Richard Hoyer, who wrote The Psychology of Intelligence Analysis, which is a superb book, talks about this very problem, both in the intelligence community, but also it applies to our business. Seeking confirming evidence is a big problem. So something we do as a structured part of our process is we try to disprove our theses. We explicitly say, how can we kill an idea? How do we break a thesis? We also say, okay, if in addition to trying to kill it, how might the same evidence support an alternative hypothesis and that we're not considering? And we try hard to understand those things. It is very difficult. It requires creativity, thinking about things you don't want to think about. The brain is not wired to do that well. So we put a lot of effort in and we're always trying to get better at that because it's a tough problem. I would say another problem is anchoring. It's very easy in our business to get anchored either to an intellectual framework or an analytical framework around an idea, or to a stock price, an entry point, or to an exit point. When people sort of predetermine when they might sell something, it's really you're predetermining it with an asterisk. You're predetermining it all else being equal. In reality, all else is rarely equal, and the data will change from the day we make an investment to the day we might want to sell it, which is why we've also added to our process, before selling something, we review what we originally thought and we review what has changed since we first invested and try to give it a fresh look as to what is the price to value relationship between the price of the security and the value of the company. So those are a couple of things that we think, they're mistakes we've made in the past. We try hard not to make in the future. And I think I've seen a fair number of other people in our business make them.
Now, you're not just a practitioner and a very successful practitioner of value investing, but you're also very passionate about sharing your knowledge with others, and you participate in an extraordinary class at Columbia Business School. And I'm really keen to understand a bit more about the class, and you've had some wonderful top-class speakers, including David Einhorn, Bill Ackman, Whitney Tilson, Glenn Tongue, and many, many others who have come to New York, to Columbia, to give students real-world experience. And also you've drawn from other disciplines to teach, as you've said, with, for example, based on your background in medicine. Can you give us a sense of how the class is, what's the process and what's so unique about this class?
Sure. So I should start by saying that I'm just tremendously lucky to be able to teach this class. It's a lot of fun. I've learned a lot by doing it. I get to meet great students and have, as you said, these great speakers that are generous enough to come speak with us. The class is the Advanced Investment Research course at Columbia through their value investing program. And the way the class is structured is it's really boot camp for analysts. It's supposed to be as real world as possible. Some things aren't exactly real world. For example, each student is assigned one company, and they analyze just that one company qualitatively and quantitatively for an entire semester. And at the end of the semester, the final exam is they have to write a one-page write-up where they say they're long or short the stock, and they can't pass or stay neutral. In real life, you get that opportunity, but not in the class. In addition to the one-page summary, there are up to 5 pages of supporting material. And then we have 2, sometimes 3 top hedge fund managers come in, and the students give a 5-minute verbal presentation on their idea, followed by 5 minutes or more of Q&A and grilling. And we ask these managers who are nice enough to come do this for us to not pull their punches, to treat this like these are analysts at their firm and they may put money on the line. What do they want to know? So it's this very unusual class. It's a small class. So the way one gets into the class is apply to Columbia Business School, then apply to get into the value investing program, and then apply to get into this class. And it's this intense small class, so we get these very gung-ho, very qualified, enthusiastic students who do a great job. And in addition, we also put a lot of time into it. I co-teach the class with Cheryl Strauss-Einhorn, and Cheryl and I, we really enjoy it. It pulls on a few different skills or areas of expertise. Like you said, it's multidisciplinary. So Cheryl is an award-winning journalist and editor, and I'm a professional investor. And we draw from a bunch of fields. We draw from the fields of investigative journalism. We draw from psychology, of course, financial analysis, competitive analysis, real-world company operational analytics. And we try to teach these different areas of skills to let the students have a toolbox that lets them research the company in a very comprehensive way. And what we say to our students is, when you're done with the class, you will know your company better than all the so-called experts on Wall Street. Because oftentimes experts miss changes in things that they're studying because they're so immersed in the field. They have deep industry knowledge and lots of great knowledge about the company and the industry and historical comparables, but when things change, it's sometimes hard for those who are deep in an industry and not broad-based to see it. Whereas our students come in, they get the benefit of speaking to lots of people and taking a fresh look, and we purposely choose companies that have a lot of tension. So the process we use, which is sort of a fun process that we use to get the ideas that we assign our students, is that Cheryl and I email about 100 people. And all these people kind of know the drill. They know we teach this class. And this class was taught before us for a long time, so it's a well-known class. And we say, look, we're looking for ideas that have a lot of tension, where there's a real debate as to the future of the company and what this inflection point is going to mean for the company long term. Can you please give us your best ideas? What fits the bill? So we have these top hedge fund managers and analysts and former students email us their suggestions, and we're just really fortunate to have a great pool of ideas to draw from. Cheryl and I discuss it, and then we assign them to the students. Now, as you said, we are also fortunate that fantastic world-class investors, like you mentioned, come speak with us. So all these great investors like, Bill Ackman, David Einhorn, you said Whitney Tilson and Glenn Tung, Paul Isaac, and a host of others come meet with us privately, off the record, in a personal setting, and spend an hour or more pretty much answering any questions our students have. And that's just terrific. It's fun. I always learn when these guys come in, and that's what we do.
That sounds wonderful, and it's really rare to find anywhere in the world such passion and also the real world teaching that you bring to the table. I'm curious just to understand a bit about the background of the students, and obviously investing is more and more a global affair, and how does that figure into the curriculum?
Columbia is an international school, and it draws from all corners of the earth, so our students come from everywhere. We get a lot of different industries. Because the value investing program run by Bruce Greenwald is so well known, the school attracts a lot of people who are interested in being value investors or analysts and then portfolio managers. From that group that apply to get in this class, we look for an interesting mix of people. So we try to have diversity, and we look for diversity across a few different factors. So whenever possible, we look for gender diversity, both men and women. We look for people who have been analysts in the past, as well as people who have never been an analyst and have come from a different field. And we look for people from different walks of life, different countries, all sorts of different things, because we find that it makes the class discussion more interesting. And a key part of our class is not just us teaching or us asking questions, but a lot of the value in the class comes from the students asking each other questions. It's a very intense, interactive course. Everybody is all in. Not only do they have to do their work and do it very well each week, but they have to listen to their classmates' presentations, and they need to ask their classmates questions and help their classmates. So we take the perspective that not only is everybody all in, and we tell people up front, if you do not want to do a tremendous amount of work, drop the class. It's not a good use of your time, or our time for that matter. So we encourage people to leave unless they're very enthusiastic. Then we structure the class in a way where the students get to interact with each other a great deal, because it hones not only their research skills and their communication skills, but it also hones listening skills by listening to their classmates, and it makes everybody have sort of a team perspective on this. You know, we sort of describe it to everybody as this is both an individual and a team sport being in this class.
And what advice do you have to young people who, other than to apply to Columbia and come
Right.
to the class, some may not be as fortunate as to have that opportunity, but in general, based on your experience as an investor as well as a professor of investing, what advice do you have to young people starting out who may be confused a bit about their direction yet are interested in investing?
What I would say, and like a lot of these things, nothing is sort of original material here, but it's the things that I've found useful or resonated with me. I think it's very important to do something you're passionate about. Life is highly unpredictable. We have no idea about our future health, our future wealth, and a lot of things in life are just hard to predict. Therefore, I think it makes all the sense in the world to do things that we're passionate about now and today. Suffering for a long period of time in the hope of some future payoff is generally not a good idea. And I think one needs to do that to some degree to follow trades or professions, and we all have to get through the sort of grunt work to learn our crafts, whether it be doctors, lawyers, or investors. But it's really important to follow passion, I believe. And oftentimes there's a way to learn how to follow passion profitably. And that's not always the case, but it's often the case. So with students, I always suggest that they go into fields they care about and they enjoy, because it's just much more fun if you enjoy the process. You know, I love what we do. I love what I do. I really enjoy being part of my company. I love being part of Columbia, and overall it's all great. It's a lot of work, but I really enjoy it. If I did not enjoy it, it would just be torture, because it is a lot of work. So my first advice would be enjoy what you do. In terms of becoming a professional investor, one, I would say most people don't need to. You can learn to be a very good investor and invest very profitably over your whole life without doing this professionally. Everybody needs to handle their retirement accounts and their savings accounts. So these are, I think, very useful skills for everybody, including just knowing you don't want to be an active investor and you want to be, and a very smart decision is for a lot of people to say, you know what, I'm not going to try to pick individual stocks and bonds. I'm going to go into index funds, and you're guaranteed to outperform more than half the professional money managers in the world if you just do that. So just understanding how this works is important. It's very competitive. If you can do something else profitably and enjoy it, there are a lot less competitive areas to go into. And if you do still want to pursue being a professional investor and try to outperform the market over a long period of time, then I think it's very important to be a lifelong learner, to have a passion for learning. And learning comes in all sorts of places. There's experiential learning, there's didactic learning, there's a host of ways to just acquire wisdom. And something Munger has talked a lot about that I appreciate the longer I do this is not a business of who's the smartest. There are a lot of very smart people that don't end up doing well in our business. Being smart always helps, and if one is as smart as Buffett and Munger, sure, that's fantastic. But most of us are not, and it is a business of acquiring some worldly wisdom, and I believe all of us can acquire worldly wisdom over time by trying to get better at this and trying to think better. And I think, a book that greatly impacted me was Poor Charlie's Almanac. And along with the essays of Warren Buffett or his annual letters and a lot of what Ben Franklin wrote, Poor Charlie's Almanac pulls a lot of this together in one book. And I've read and reread that book several times, and each time I do, I seem to get something else useful out of it, some other nugget or pearl of wisdom. So for me, that's what's been helpful.
What goals do you have for Spencer Capital and also for your teaching career?
I think as a near-term goal, I think it's important to try to do these things as well as possible. So excellence is a goal. We don't have very specific size or performance targets. We try to be as smart as we can and make the best decisions we can on every day, in a risk-weighted way. So we're just trying to make good decisions each day and see where that leads us. We're very clear internally about certain things like what risks we will or won't take, and thinking about portfolio risk and adverse events and future possible outcomes of the world. We don't take it for granted that the world is going to work out any one particular way. So our goal is to do a good job for our clients, enjoy it, and from Columbia perspective, teach as well as possible.
Great. Well, on that note, Ken, thank you very much for your time and all the
Thank you.
insights.